The core of the carry trade is simple: borrow money where it's cheap, and lend it where it pays well. You take a low-interest currency, like the Japanese yen, and use it to buy a high-interest currency, like the Australian dollar. The profit comes directly from the interest rate differential between the two nations' central bank policies. You open two positions simultaneously. You sell the low-yielding currency, essentially borrowing it, and buy the high-yielding one. The daily interest you receive on the long position is larger than the interest you pay on the short position. That net positive flow, paid daily to your trading account, is the carry. It sounds like a free lunch, but it carries a massive, often underestimated risk: exchange rate volatility. The interest rate differential might be a few percent per year, but a currency pair can move several percent in a single day. A sharp move against your position can wipe out months, even years, of accumulated carry profit overnight. The most dangerous scenario for a carry trade is when the low-interest currency strengthens sharply. This is often called a carry trade unwind. When risk aversion spikes in the market, investors rush to repay their cheap loans by selling their high-risk assets, forcing the funding currency up and the investment currency down. Successful carry trading requires extreme patience and a long-term horizon. You are not looking for large price swings, but for a slow, steady collection of interest. This means you must choose currency pairs that are not only high-yielding but are also expected to remain stable in value over time. The Australian dollar versus Japanese yen is a classic pair, but the New Zealand dollar and emerging market currencies like the Mexican peso can also be targets. The key is to find a currency with a strong fundamental economy to support its value. Paired with a perpetually low interest rate currency like the yen or the Swiss franc, you cannot ignore leverage. Using too much leverage is the fastest way to get stopped out of a winning carry trade due to a temporary market hiccup. A conservative, well-capitalized position is your only defense against the natural volatility that will test your conviction. Ultimately, the carry trade is a bet on the stability of the global financial system. When the world feels calm and investors are confident, it can be a reliable income generator. When fear takes hold, it becomes a trap. Timing and risk management, not just the interest rate math, is what separates a profitable carry trader from a statistic.